Hi, and welcome to the 2019 third quarter investment call with the San Diego Foundation. I'm Brian Zambano, Vice President of Development and Stewardship. Thank you for joining us today. These quarterly investment calls are an enhanced service to our donors. They provide direct access to our investment leaders in a consistent, convenient, concise format so donors can remain informed about the performance of their charitable assets. Leading today's discussion will be Steve Klosterman and Matt Fettig. Steve Klosterman is Regional Director at Halbert Hargrove and serves as investment chair for the San Diego Foundation Board of Governors. Steve advises a wide range of individual and institutional clients and began his investment management career more than 30 years ago, building his own registered investment advisory business. Steve is past chair of the UCLA Foundation and a founding board member of the UCLA Investment Company, which oversees an approximately $3 billion endowment. As Chief Investment Officer for the San Diego Foundation, Matt Fettig oversees and manages our investment strategies and activities. These include working with the Board Investment Committee, senior staff, auditors, professional volunteers, fund managers, and outside consultants to establish, maintain, administer, and monitor policies related to foundation investments. Today, Steve and Matt will start the call with a brief macroeconomic update, followed by performance and attribution reports for our endowment portfolio, our long-term, medium-term, and short-term portfolios. We will conclude with a question and answer session. To submit questions, please use the questions chat function located on the webinar sidebar menu anytime throughout the call. Any questions unanswered during today's call will be answered via email. Attendees can access slides and a recording of today's call on our website at sdfoundation.org by tomorrow. Now, Steve Klosterman will get us started.
Thank you, Brian. Thank you, callers, for listening in. As far as macroeconomic overview, obviously we've had a long bull market overall since the market low was back in 2008, and then the recovery started in March of 2009, and it's pretty much been a heck of a good run. Some people feel, valuations are high, etc. When it comes to the U.S. market, you can go a long time without any significant downturns. People forget in the 80s and 90s you had 20 years where the S&P 500 only had 2 down years, and both of those years were less than 5%. I guess my main point there is we don't try and time the market. We run a highly diversified portfolio. I'm going to talk more about that because we don't believe in market timing, and I am not aware of any institutional investor with a long horizon that really tries to time the market. The other thing that I'll bring up is, if you want like macroeconomic overview, very simplistically, our economy is 65 to 70% consumer driven, and you've got very low unemployment, and you've actually had a little wage increase. So people have money to spend. We'll see how the Christmas shopping season goes, the holiday shopping season. But, those are the two things I would watch is unemployment and wage. But as long as consumers have money to spend, that bodes well, at least for our U.S. economy. As far as the world, we've got an emerging, middle class, and that's a good long-term play. So I'm not overly concerned, and again, we don't try and time the markets. If you look at your slide here, one of the key components of diversification is hedge funds. And hedge funds kind of got a bad name in a lot of ways. With Matt's leadership and our committee, I think we do it right. If you look in the upper right-hand corner, you'll see a comparison of a hedge fund index, and they're hard to index compared to the S&P. But basically, not as much upside and not as much downside. And that's exactly what we're looking for when we diversify. And you also see that in the lower right-hand corner, the comparison to bonds, basically the Bloomberg Barclays US Ag. Here, not as in up markets, not quite as good a return. In down markets, a lot better return. In fact, a positive return versus a negative return. So that too is part of that diversification, and diversification in particular, what we're looking for is what they call low correlation. We don't want everything moving in the same direction, same degree at the same time. So we think hedge funds are an important part of a diversified portfolio. And with that, we'll move to the next slide. Another big area of diversification, a very important area with the highest expected returns, and at least historically over the time period you're seeing of 20 years, had the best returns, is private equity, specifically buyout and growth equity. And the MSCI ACWI is the All World Country Index, so it's an all world stock market index. I'm not suggesting that our forecast would be for these same returns you see, or even for that dispersion, that differential to be so great. But suffice it to say, again, I'm not aware of any institutions that don't expect higher returns in private equity than they do in public equities. And they can also offer lower correlation. The other thing related to this is you're taking a big risk when you don't participate in the private markets, because they've grown, whereas the public markets have shrunk. If you look in the upper right-hand corner, the number of U.S. listed companies, you used to hear about the Wilshire 5000, you used to hear at one point that was, you can see over 7,000, really over 7,500 companies, but the public market has shrunk. So there's fewer companies in that universe, and the private market has actually grown. So you can miss out, particularly in certain industries and things, if you're not open to investing in private equity. So one of the things that we can offer that a lot of other funds, community funds and some of the commercial funds, donor advised funds, can't offer is this kind of diversification, particularly in the private equity. If you look at the next page, you'll see that the average investor really doesn't do too well left to their own device. You'll see a 1.9% return over this 20-year time period compared to all these different other investments. One of the reasons that investors tend to shoot themselves in the foot is going back to where I opened up, which is they try and market time. They think that they also think that past performance is an indicator of future performance when it's not. They think something that's done well recently is going to continue to do well. So one of the keys is to just be diversified, stay long run, think long term, and not undermine your own success. If you go to the next slide on 4, you can get some really bad down markets, and you can, on paper, lose money, but if you stay in, you're going to do well, and the facts are cash doesn't rally. Right now, you're going to earn fairly meager returns, even though returns have gotten a bit better in cash, but the facts are you're not going to beat after inflation, and then if you have to pay taxes on that interest, if it's in a taxable account, you're actually losing money. Yes, you'll get your own money back and a little bit of interest, but again, after taxes and inflation, you can't buy as much in the way of goods or services. So cash is not a good alternative for an investment. It's a good cash reserve for emergencies. Everybody should have some, but I would not park a lot of money in cash. And that circles back to the prior slide. One of the ways average investors undermine their success is they get out at the wrong time and they park their money in cash. So with that, I'm going to turn it over to my colleague Matt to talk about our current performance.
Thanks, Steve. And I think that segues nicely into talking about the endowment's performance for the quarter and year-to-date periods. As you know, we run this endowment portfolio in a highly diversified fashion, and it's designed to last forever, for perpetuity. And that allows us to take on exposure to even more asset classes and really obtain that diversification. So as you look at results here for the third quarter, you can see we were up 0.3%, just slightly trailing the policy index. And, that really, by looking at the number, does not tell the story of what happened throughout that 3-month period. Remember, there's quite a bit of volatility around a number of different fronts, including trade with China, interest rate policy. The Fed began cutting interest rates, and a number of other macroeconomic factors. So there was certainly volatility throughout those 3 months, and we're happy to report that we finished off with a positive number. Certainly, the third quarter doesn't tell the story of the year-to-date period starting on January 1st, where, if you recall, late in 2018, we had a fairly large market correction, peak to trough of about 20%. January 1st, or actually just after Christmas, the markets were back off to the races. And so we were able to capture a lot of those strong gains that the market gave us in the first quarter and second quarter of this calendar year. The end result, as you see over the year-to-date period, is a great return of 10.7%. Anytime we can produce double-digit rates of return, we are very happy with that, slightly trailing the policy index. So what exactly happened? Well, we know equities have rallied pretty significantly since January 1st. And as you go down the list and look at some of our managers that participate in equities, they're up close to 20%, if not more than 20%, on that year-to-date basis. It's pretty amazing. At the same time, recall around this time last year, interest rates really started to move up in the early fall, and the market started to correct. And at that time, interest rates fell dramatically, and it really continued to fall into the third quarter. And the result of that, as you have falling interest rates, you have an inverse relationship with bond prices, and therefore bond prices go up. So we have had, despite all of us calling for very little return coming out of fixed income or bonds, we have had an incredible rally over the course of the last year. Bonds are up over 10% on a one-year basis. Now, unfortunately, us, as well as our investment managers, certainly didn't see the move downwards in interest rates to such a degree as occurred. And so a lot of our managers weren't necessarily positioned for this massive decrease in interest rates. So a little bit of our underperformance relative to our benchmark came from that factor. And I would just note, in just about every institutional portfolio I've looked at, others had very similar experiences. A couple points that of interest I'd like to highlight as far as contributors, both on an absolute and relative basis. Our private real estate portfolio has really taken shape, has reached a level of maturity, and is offering very significant returns in the kind of 8 to 10% range over the last 3 to 10 years. It is, I think, the strongest area of our portfolio today. It includes exposure to things like multifamily developments, office buildings, industrial buildings, in a small amount in retail, think perhaps malls. And I just want to highlight, over the last year, that area is up 9.7%, almost doubling the performance of its benchmark. So very strong performance there. The one area that we've had that's lagged a bit continues to be the private equity area. And you saw the very robust returns that Steve posted relative to stocks over the last 20 years. We don't expect an exact repeat of performance of the last 20 years, but we do expect to get compensated for taking on some illiquidity, which we can do in a perpetual endowment portfolio. However, in the early years of building out a private equity portfolio, you have an effect that actually causes you to lose a little money before you start to really make quite a bit of money. And we're right in the middle of that process right now. hoping to pull out of it relatively soon, which should result in some very robust returns for the endowment portfolio. So if we go to the next slide, we'll talk a little bit about our non-endowment portfolio, starting with the long-term portfolio. The long-term portfolio, it takes a very long-term approach and takes on considerable amounts of risk to get to a 7% type rate of return over time. And you can see over 10 years, we're just about there, 6.5%. There is significant exposure to stocks in this portfolio, and therefore it has been a bit of a volatile ride. In the quarter, the stocks were certainly the highlight, as they were on a year-to-date basis, but really similar themes to what we experienced in the endowment portfolio. Fixed income, while on an absolute basis was up 10% for the last year, we slightly underperformed, resulting in the underperformance relative to the benchmark. All that said, on a year-to-date basis, we're now up 12.2%, and we're quite happy with those results. We just received results through October, and in both the endowment and the long-term portfolio, we were able to produce positive rates of return that exceeded our policy benchmark. So adding on top of what has been a very good 2019 so far. So if we move on to the medium-term portfolio, medium-term portfolio takes modest risk. It has 30% exposure to stocks. It has about 70% exposure to fixed income and cash. It too has certainly benefited from the move we've had in the stock market and the strength in the bond market. In this particular situation, we did underperform on the fixed income side for similar reasons. But you can see year to date, this portfolio is up 9.4%. If you ask me over a long period of time what I expected from this portfolio, it would be a 4 to 4.5% rate of return. So knock on wood, we'll see what the market does before the end of the year. But this is certainly a robust return year to date, not one I'd expect to duplicate all that often. And then finally, we'll move on to the short-term pool. And remember, our short-term portfolio is invested solely in money market securities, money market funds. It's highly dependent on the direction of short-term interest rates. So we had reached a place where interest rate policy was neutralized, interest rate increases began to take place. We went from receiving hardly any yield on this portfolio to over 2% a year. And now the Fed has backtracked with 3 consecutive rate cuts, which will ultimately mean the yield on this portfolio will have a downward trajectory going forward. We'd encourage anyone that's in this portfolio that has a long time horizon. As Steve mentioned, we understand if you don't want to take risk with your charitable dollars, but if you have a long-term time horizon, oftentimes cash will not eclipse the rate of inflation. And so you'd actually be losing your charitable dollars in a sense by keeping them there. So that's the conclusion of my prepared remarks on performance. I'll hand it back over to Brian.
Thanks, Matt. Thanks, Steve. Now's when we usually take your questions, but I'm excited to ask a question of my own for the first time. Matt, is there any new exciting options for our donors as it relates to portfolios?
Well, thank you, Brian. There absolutely is, and this is something I want to share with everybody. Over the years, we have had donors with interest in particular areas. Some that wish to divest from fossil fuels, others that do not want any exposure to alcohol, tobacco, firearms, contraception, perhaps for religious reasons. And as many of you know, in response to that, we opened a new endowment portfolio almost 5 years ago now, that we called Social Choice. And that endowment portfolio is only $3 million in size, but it seeks to invest in companies that screen well on environmental, social, and governance criteria, otherwise known as ESG, the acronym. That did not address all of our donors' wishes, particularly with the robust climate program we have here at the foundation. We had other donors saying, it's fine to invest in clean energy, but I'd rather just not invest in oil and gas at all. And so effective January 1, we will be shifting the social choice pool, it's an endowment portfolio, to not only invest following ESG criteria, but to also minimize exposure to fossil fuels. And I'm also excited to announce that on January 1, we will now have a non-endowment option available to our fund holders. And so if you invest based on a set of values and those values align with what I'm describing right now, we'd really encourage you to reach out to your donor manager, and we can certainly provide you some more information about what we plan to do and what it will look like. And see if you might have an interest in shifting your fund into this portfolio, or adding new contributions to this portfolio. So we're excited about it. It is in process right now. We're hoping for a January 1st launch.
Thanks, Matt. And actually, thanks to the entire investment committee for addressing this issue and providing our donors with such a great opportunity for their funds. Know that there'll be a lot more information coming out to our donors about this opportunity in the new year. We look forward to partnering with you and finding out the best way to invest your charitable dollars here at the foundation. Sorry if we didn't get to your questions today, but if you did submit one, we didn't get it, we'll follow up with an email response. So thank you again for joining us today and for partnering with the San Diego Foundation, where we're leading change today for a better tomorrow. Today's presentation will be available on our website at sdfoundation.org/investments. Thanks again and have a wonderful day.